We need a big house cleaning at the Fed, a dramatic reduction of their mandate, their remit. But it's not likely to happen until we have a big crisis and people begin to realize what they've actually been doing, and you get a political revolt and a discrediting of the institution of the Federal Reserve, the central bank, and then maybe there will be a chance to reform and rein in this rogue institution. But for right now, you can see exactly how out of control they are.
Hi, and welcome to the X22 Report Spotlight. Today's guest is David Stockman. David is a former Reagan White House budget director. David is a New York Times best-selling author. His new book is Peak Trump. He is the editor of David Stockman's Contra Corner. That is davidstockmanscontracorner.com. And I am very happy to have him on the X22 Report Spotlight. David, welcome to the Spotlight.
Happy to be with you.
Hey, thanks for being here. And I just want to start off with the economy. I mean, everyone's looking at the economy. Everyone's saying, wow, look at the GDP numbers. They look fantastic. Look at unemployment. Incredible. The stock market is at all-time highs. I don't think we've ever seen the stock market so high. And then we have the other end where the mainstream media, they're out there, they're talking about a recession. We hear certain individuals in the IMF, the biz, they're talking about a recession. Now, we have two things going on here. We have Trump, where he's showing fantastic statistical numbers. And then on the other side, we have the mainstream media, we have financial pundits out there saying that we have problems in the economy. When you look at this and you look at the entire economy, not just here in the United States, but around the world, what do you see?
I see an economy where they have not outlawed recessions. I see an economy that on the surface looks healthy, but the foundation is rotten. And I see a drift and kick the can process that's been going on for decades in Washington, both at the Fed and on Capitol Hill, that together adds up to a very serious threat to what looks to be a healthy situation. Now, what I mean by that is there have only been two long business expansions in history. One was the 1960s, the so-called guns and butter boom of Kennedy Johnson. It lasted 105 months. Near the end, the unemployment rate was below 4%. In fact, got down to the low threes. It looked like blue skies forever. But underneath, massive deficits were building up, and the economy got into big trouble in 1970, and the next thing you knew, there was a recession. We had the same thing in the 1990s, a 119-month expansion, the tech boom, the dot-com boom. We got to the year 2000, 4 years straight of 4% or better GDP growth. The argument on Wall Street was this time is different. And even though, PE multiples were crazy, we were told, don't worry. And then came March 2000, 2 years later, NASDAQ 100 is down 83%, and the whole thing is falling apart. And then, of course, we go and do it again. My point here is, we're in month 116 of the weakest expansion in U.S. history by a long shot, 3 months from the record, and we're facing a situation that we've never been in before this late in the cycle, which is an exploding deficit, which will be $1.2 trillion this year. And remember that even the Keynesians thought that when you're at the top of the cycle, at the top of the so-called boom, you're supposed to rein in the deficit or even balance the budget. We've gone in the opposite direction. And second, we have a Federal Reserve that is basically comprised of cowards who have ducked and dithered and delayed normalizing monetary policy, interest rates, and their balance sheet for years. And now they're belatedly trying to do it and giving all kinds of conflicting signals. One day, quantitative tightening or shrinking this bloated balance sheet. is on automatic pilot. The next day, well, maybe we're going to put it on pause. This is not helping investor confidence, and it's merely a sign that we have a central bank that dominates our financial system, totally dominates it, that is run by people who are flying by the seat of their pants and are utterly confused and have been doing things that defy every norm and principle of sound money and finance that mankind has known about for several centuries. So therefore, the bottom line is what you see on the surface is in the rearview mirror. It's the end of a artificial cycle propped up by money printing and debt. And we're now heading towards a day of reckoning where all of this is going to come unwound.
Now, why do you think the Fed decided to do an about-face? I mean, they were raising the interest rates as soon as Trump came into office in 2016, actually a little bit before that, and then through 2017, through 2018, and all of a sudden they put the brakes on and they said, well, wait a minute, we need to be patient right now. And also they were unwinding their balance sheet, and all of a sudden they're backtracking, like you said, on that. Why all of a sudden did they just do an about-face?
Because but, I hate to say it. It sounds kind of simplistic and unfair, but they're cowards. They are, completely enthralled to the robo-machines and day traders on Wall Street. And we got a big downdraft, which was more than long overdue in mid-December, and then Christmas Eve, a real blowout. And they just panicked. Because somehow they believe the job of the Fed is to keep the stock averages moving higher and higher on the theory that this will make people feel wealthier, and if they feel wealthier, they'll spend more, and if they spend more, you have a better economy. Well, that's nuts. That's Keynesian baloney, okay? And what they're doing is basically harming and penalizing Main Street, and we can talk about how that works, even as they continually inflate the bubble and then rescue it on Wall Street. And we're ending up with a bifurcated economy that I think is an accident waiting to happen. Why do I say that? Well, let me just give you two basic facts of life, which I think illustrate this pretty dramatically. If we look at Wall Street from the high point before the crisis. In other words, I'm not starting at the very bottom in March 2009, because you can make anything look good if you start at the wrong point of the cycle or the low point. But if you start at the high point before the crisis, the fall of 2007, and look at the NASDAQ 100, which is really the leading edge of this stock boom that we've had, the tech stocks, it's up 200% in real terms, even after you adjust for inflation. Again, peak to peak, from the fall of 2007 to the last fall of 2018, 200%. If you look at Main Street, and there are two key indicators that I think you have to follow. One is, how many hours of labor are we putting to work? Forget the BLS unemployment rate and the jobs count. That's apples and oranges. A 10-hour-a-week part-time job at McDonald's counts the same as a 50-hour-a-week full-time job in a coal mine, if there are any left. So forget that. Look at hours. In 11 years, the hours are up only 7% in the U.S. economy from the last peak to this one. 11 years, 7%. That is pretty pathetic compared to history, where growth in labor hours is one of the components of rising living standards.
Programs that were set up a long time ago. I mean, is he just running this whole thing into the ground? And then we know that he's a master of debt. He's a master of bankruptcy. Is he just going to run this, overheat it, bring us to a default and say, something? There's nothing else we can do here. We're going to have to default on the debt, on this debt that we owe the Fed.
Well, who knows what could happen down the road? I don't think that's his intention. Somehow he thinks he spent his whole life as a real estate developer using tons and tons of debt, and he somehow got away with it, other than a couple of brushes with bankruptcy and a couple of those casinos. So I think the problem with Donald Trump is that when it comes to debt, he's kind of fearless, and I guess you can understand it. He doesn't understand economics. He's a businessman who borrowed and built, and it seemed to work during this period in which the Fed was driving interest rates lower and lower and monetizing the debt, and everybody was living a fantasy. But, oddly enough, he becomes president at a time when all of this is coming to a abrupt end. And by that, I mean the Fed is no longer monetizing the debt. By that, I mean buying bonds and thereby, affecting the price, supply-demand price equation in the bond pits. When the Fed was doing $80 billion a month, just think about that. That's $80 billion of the equivalent of artificial savings coming into the bond market saying, I did, whatever the interest rates were back then, 2% or less on the 10-year. So it was a huge falsification of bond prices too high and yields too low. But my point is, after they took the balance sheet from $900 billion on the eve of the financial crisis in 2008 to $4.5 trillion, they had monetized about $3.5 trillion of debt, and now they're pretty much saying they're going to leave it that way, even though they've shrunk the balance sheet a little bit to about $4 trillion. The key point is whether they pause now in QT, which is the opposite of QE, that's quantitative tightening or shrinking the balance sheet and demonetizing the debt, whether they pause or, continue to try to do the right thing is somewhat secondary compared to the change or the pivot from the last 30 years of history. If you look at the balance sheet of the Fed and every other central bank in the world over the last 30 years, it's been doing nothing but expanding, sometimes very rapidly, sometimes only moderately rapidly. But here are the numbers, and again, I think you have to mind the quantities. When Greenspan took over, he started this whole thing. I call it bubble finance from Bubbles Alan Greenspan. But when he took over in August 1987, the balance sheet of the Fed was $200 billion. It had taken 77 years to get there from when it opened its doors back in 1914. It reached a peak of 4.5 trillion. So in 30 years, you had like a 22-fold increase in the size of the balance sheet. What were they doing? They were using fiat credit plucked out of thin air, or essentially digital, hitting the buy key at the Fed's computers to buy what amounted to 4.3 trillion of bonds that represented real stuff. The government issued the bonds. They paid government salaries. They bought aircraft carriers. They sent up satellites at NASA. All the other stuff government does, and it was all paid for by fiat credit. That's what was going on for 30 years, and my key point here is it stopped. The Fed has finally stopped because even the Keynesians who run it recognized you couldn't do this indefinitely and at greater and greater magnitudes, and it's now spreading to the rest of the world. The ECB has stopped their quantitative easing program. Today they came up with something different, but it's only temporary. And frankly, other central banks around the world are going to have to do the same thing. That is, begin to shrink or at least stabilize their balance sheets. That will change the whole dynamic in the financial systems of the world. It's going to eventually mean higher and higher yields because governments are going to keep borrowing and the private sector will be on top of that. And as yields and interest rates go up, the price of so-called risk assets like junk bonds and stock is going to go down because, the whole system is predicated on cheap debt. The biggest buyer, as I think a lot of people now recognize, of stock over the last 10 years since the crisis has been the companies themselves. And overwhelmingly, the Fortune 500 or the S&P 500 companies have borrowed money cheaply because the Fed kept interest rates so low. in order to buy back their stock. That didn't create one iota of competitive advantage. It didn't generate productive assets that a company could use to grow or to compete more effectively. It simply was pumping the capacity of their balance sheet and their cash flow back into Wall Street in order to boost their stock price. So it was really a vicious circle. And it's another reason why we have such a big growth problem, I think, in our economy, because essentially corporate America has strip mined itself by buying back stock, engaging in massive unproductive M&A deals that end up, basically being a waste, and goodwill gets written off and all the rest of it. This is what's been going on, and it all stems from a rogue central bank that has, lost any sense of discipline and has abandoned every principle of sound money that anybody knew about, even as recently as 1981, when I, became budget director under President Reagan, and Volcker was at the Fed and was courageously and steadfastly doing the right thing to get the finances of that era under control.
So what is the purpose of having the Fed right now? They create currency with interest attached. Wouldn't it be better if, just like our founding father said, that the government creates the currency with no interest attached? Because when I look at the Fed's record, I mean, all you see is these ridiculous cycles. Build a bubble up, pop it. Build a bubble up, pop it. Build a bubble up, pop it. And we owe all of this debt. And like you said, it's going to be up to, what, 40 trillion or something? Right now we're at 22.
The federal budget deficit, the debt of the Treasury will be 40 trillion. Some part of that will be owned by the Fed, and some part of it will be owned by other central banks around the world, and other parts will be owned by investors, insurance companies, and mutual funds, and so forth. But the point is twofold. One, the 40 trillion that we're heading for, even if think if the average interest rate from 30-year money to 90-day money is 3%. That's below history, okay? That barely covers inflation and taxes. But if you normalize it, just to think about it for a second, at 3%, and you got 40 trillion of debt, that's 1.2 trillion a year just of interest on the government debt year after year before you send out a single veterans check or funded a single Head Start slot or bought an aircraft carrier, which we don't need, but they keep buying. See, my point is that is real, and it's going to bite and bind increasingly harder as we go forward in time. Now, the second part of your question is, what about the Fed printing all this money and monetizing parts of that giant debt? They shouldn't be doing that. In other words, capitalism doesn't need, a central bank constantly trying to prop up the stock prices and stimulate the economy and pegging interest rates at artificially low level. The federal funds rate, which is the overnight money, they had pegged at practically zero, 12 basis points, which is really the same thing as zero, for 7 years running. That's insane. Money has to have a price, or you're simply going to encourage speculators to borrow the overnight money at zero and try to buy something that has a yield or is going to appreciate. But that's speculation. That just, over time, it destabilizes the system and creates artificial wealth transfers that aren't justified and that harm the economy over time. So the Fed should be out of the bond market. It should be out of Wall Street. Let Wall Street live or die on its own. If people speculate too much, let them lose money and learn a lesson. If they borrow too much, let them go bankrupt and lose their equity. That's the only way that capitalism can work. There have to be two-way markets. There has to be gains and losses. You can't socialize risk and privatize profit. It's an unstable system, but that's where we are. So could we fix it? Yeah, we could fix it by re-engineering or restating the charter of the Fed. Right now, they're almost like an economic czar. They can do almost anything they want. Allegedly, they have a mandate to pursue maximum employment and stable prices. But what do either of those terms mean in today's world? Okay, they can define those terms any way they want. So I think we need a big house cleaning at the Fed, a dramatic reduction of their mandate, their remit. But it's not likely to happen until we have a big crisis and people begin to realize what they've actually been doing, and you get a political, revolt and a discrediting of the institution of the Federal Reserve, the central bank, and then maybe there will be a chance to reform and rein in this rogue institution. But for right now, you can see exactly how out of control they are.
Do you think it's time to have a full and complete audit of the Fed?
Of course. Yeah, I mean, that would just be an obvious no-brainer first step. They operate in complete isolation financially from the rest of the federal government, okay? And they take in a lot of revenue, believe me, because they were able to print money without any cost over the years and own right now $4 trillion worth of bonds and, Fannie Mae and Freddie Mac securities. On that, they're earning about $120 billion a year, and they have almost no costs except, a bunch of people running around doing research that is mostly self-justifying for the institution anyway. But it's a real monster is what you have there, and we need to dig into it from top to bottom.
David, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work and get your book?
Well, Peak Trump is available on Amazon, both in an ebook version and a printed version. And then a lot of the things that we've been talking about today and that I cover in the book are subjects, the Fed, Wall Street, the international economy, the trade war, as well as the fiscal and foreign policy dimensions. All of that I cover daily in a newsletter called David Stockman's Contra Corner, which people can subscribe to. Simply Google David Stockman's Contra Corner and it'll come up, and you can take it from there.
Great. I'll put all the links at the bottom of the video and make it a lot easier for people to go to your site and get your information. David, once again, thank you very much for being on the X22 Report Spotlight.
Great to be with you.
Thank you.